Welcome to Manage Your Damn Money with Ben and Malcolm, where we trade in personal finance advice for entertaining conversations about money and millennials. Welcome world to yet another amazing episode of Manage Your Damn Money with Ben and Malcolm, where we talk about money and millennials. Malcolm, what is going on with you today, sir?
The usual. I'm a little tired. I went to visit my mom for my usual weekly visit, and she put me to work.
Okay.
I was raking leaves for like hours and hours and hours, and reminded me of
How old are you?
Right, exactly. Like I felt like I was like 16 again, and it was like, you're not going anywhere until this backyard is clean. I'm still tired.
You were raking your mom's leaves?
Yes.
That is hilarious.
Because I am too cheap for her to allow her to pay somebody else to do it.
Well, God bless you then. You're a good son.
For now.
Speaking of moms, my mother's landing actually tonight to come in to help with the whole triplet thing.
Man, you gonna get an extra 42 minutes of sleep?
Maybe. I don't know. We'll see if she's helpful in that way or not. I hope she is. Another quick thing that I just realized, separate from all that, just how stupid Black Friday is. Like, we're in that holiday season, and our topic today kind of touches on it a little bit. But like, just think about how stupid Black Friday is.
From which perspective, though?
From this perspective. We're going to put on sales and make it seem like a big deal so you can come spend money. Mm-hmm. Like, just, I was watching like a news piece on Black Friday. You know how they do on the news. The lines, people are going, da-da-da-da. And this woman was like looking at a shirt. She was like, oh my God, it's just $9. That's a good deal. And I'm like, just the logic of that. Like, you're going to a place to get deals, but you are spending the money. And it's almost like the logic is reversed. Like, they're doing us a favor.
I asked from what perspective, because if you are the retailer, it's genius.
Right.
You created pandemonium over absolutely nothing.
Right.
So my beef with Black Friday is it's always about a TV. And then my question to the folks shopping at Black Friday is, how do you need a new TV every year?
Right.
What did you do with the one you got the great deal on last year?
Right.
People are always lining up through the parking lot to get a cheap TV. How many rooms do you have in your house? Like, that is my biggest gripe about Black Friday.
That's funny.
Like if you were giving away something of substance, I'd be in line too if it was a significant enough discount.
Right.
But like, I went and bought an iPad one year, Black Friday special, on a Saturday. Still got the same deal as everybody who was there Thanksgiving Day. So, like, I have so many issues with Black Friday.
You know, it's funny. I do low-key need a TV, though. So,
well, you miss...
there's that.
You miss clipping the coupons and deciding which one you're going to go after. And you got to just figure it out when, like, I don't know, you go to Amazon. They have deals on everything, apparently.
Indeed. Well, on this episode of Manage Your Damn Money, we're covering a topic that's adjacent to some of what we just talked about, the risky but fascinating world of credit card churning. We're going to cover that a little bit later in the show. But before we do, as we do on every show, it is now time for headlines. Here's how the Fed rate hike will impact you. This was a fall 2018 piece on CNBC.com. And this is about the federal interest rate. The latest quarter point increase brings the federal funds rate to a new range of between 2 and 2.5%, which will have far-reaching consequences for consumers. The Fed's eighth hike in 2 years pushes the federal funds rate target to a new range of 2 to 2.25%. That rate is closely tied to consumer debt, particularly credit cards, home equity, lines of credit, and other adjustable rate loans. The cumulative effect is growing, and it's going to place greater strain on households with variable rate debt and tight budgets, said Greg McBride, chief financial analyst at Bankrate.com. While the average interest rate on savings accounts is still only 0.2%, which is hilarious, some top-yielding savings accounts are now as high as 2.25%, which is pretty good. And that's up from 1.1% in 2015. And with a savings rate or annual percentage yield of 0.2%, a $10,000 deposit earns just $20 after 1 year. At 2.25%, that same deposit would earn $225. So that's a huge difference. Malcolm, what is the government trying to do when it raises and lowers interest rates? I thought this was like something that's a very practical application for normal people. What is it that's happening when the government raises or lowers interest rates?
Essentially, you guys are having too much fun during Black Friday, and you're able to buy too many discount TVs at one time. And so to keep from the party going too far out of control, when they raise interest rates, because we're such a borrowing economy here in the United States, it slows down consumption. So I don't want things to get so far overblown that everybody's got money to go buy whatever they want to whenever they want to, because that creates inflation. So if I increase interest rates, it's going to cost you more money to borrow that same money you were going to borrow last month, which will slow you down and make you less likely to borrow money again, or less likely to get approved to borrow, and that also gets the same result.
That wipes it out. You actually mentioned off camera before we started this show, like you were looking at a house with your fiance, and somebody who could afford the house at one rate, but then when the rate got pushed up, suddenly that person couldn't afford it.
So she was that close to the wire that slight move in mortgage rates was enough to then be what's the word I'm looking for? Disqualify her from being able to afford it. So then what that does is it slows down the amount of people buying houses, so that inflation doesn't get too far out of control, but the economy can still continue to go, because the Federal Reserve's job basically is to make sure that the economy is stable in one direction or another. So when we had the recession that hit in 2009, post 2008 financial crisis, they immediately slashed interest rates down to zero, so that you can go borrow cheaply, induce you to get out and spend money to help bring the economy back.
That's a very excellent explanation. I remember when my wife and I were looking at buying our home, that conversation about the Fed raising the interest rate was like a weekly thing, and we were like checking the rates. We were asking for, has the rate moved? We knew it was coming, and we got in before the next rate hike. But
I'm going to look for a Black Friday mortgage sale.
I don't think they do those here in the United States of America, but I don't know. Keep looking. The article that we pulled went on to say, for starters, credit card rates are already at a record high of 17.3% on average, according to Bankrate. Most credit cards have a variable rate, which means there's a direct connection to the Fed's benchmark rate, and as interest rates rise, cardholders will continue to get squeezed. The typical American has credit card balances of over $6,000, according to Experian annual study on the state of credit and debt in America. Total credit card debt has reached its highest point ever, surpassing $1 trillion in 2017, according to a separate report by the Federal Reserve. The economy, the Fed, and inflation all have some influence over long-term fixed mortgage rates, which we just discussed, which generally are pegged to yields on U.S. Treasury notes. So there's already been a spike since the Fed started raising rates. The average 30-year fixed rate is now at 4.7%, up from 4.09% in 2015. That has cost the average home buyer roughly $42,000. And that's, again, just the movement in what it costs to borrow money.
That $42,000 is assuming you stay in that 30-year mortgage for the life of the mortgage.
And then currently the average 5-year new car loan rate is 4.8%, up from 4.3% when the Fed started boosting rates, while the average 4-year used car loan rate is 5.49%. Up from 5.26 over the same period, also according to Bankrate. And of course, private student loans may be fixed, and they also have some that are variable rates tied to the LIPR, prime or T-bill rates, which means that as the Fed raises rates, borrowers will likely pay more interest, although how much more will vary by the benchmark. Malcolm, question for you. As trends like higher rates continue, what can we expect about the affordability of major credit requiring purchases?
So mortgages, it isn't as big of a difference as you probably would expect. So like going from 4.5% to 5%.
It might change like $30 or $60.
It'll be, tens of dollars. But not enough to necessarily, in my opinion, not enough to necessarily make you not want to buy a house anymore.
Suddenly.
But on a car, it's a little bit different, because the purchase time period is 5 years versus 30 years.
The term of the loan is much.
So that 0.5% of interest rate actually will make a significant enough difference in your pocket for this car that you're purchasing. And then also, because in the beginning of a loan, the way that the structure works, more of your payment goes to interest than to principal.
Right.
So in a car loan, that interest rate move is going to make you pay way more in interest if you decide to trade that car in, in 2 years, 3 years, whatever people typically tend to own it. So purchases like that, I think it matters a little more than buying a house.
Okay.
But the house is the one that everybody tends to freak out about and pay more attention to and what have you, because I guess they just aren't doing the math.
That's the American dream too. And also, it's funny because it was talking about credit cards and the way that it's tied to the Fed. It's funny because I have one of the same credit cards that I had from when I was like a teenager. And that's the one that's actually, it's a locked rate. So it's been locked at 9% for the last decade and it doesn't move. And that's the card that I use like frequently for like, paying bills and whatever else. Then we have another card that's actually our family card. And that's the one that's variable rate that we got more recently. And when I see credit card rates nowadays, I'm like, yo, what? Why is there a 23% interest rate that moves on a credit card? That completely de-incentivizes
somebody
me
will take it.
That's crazy to me.
So, quick diversion. Great time to be calling your credit card company and asking for a cut in your rate. Because of how much interest rates have come up, everybody's competing for your business right now. And so, great time to be calling them and saying, hey, what can we do here?
I like that.
But to get to your point, 17.5 being the average rate on credit cards is just
wild.
outrageous.
Yeah.
Like if you're a person who actually carries a balance on a regular basis, like how are you supposed to actually pay that? You got $1,000 outstanding balance and you're paying 17% on it, and then or a larger number, $10,000, and you're constantly paying that. Like that is absolutely ridiculous. But yeah, the interest rates, moving have some bearing on that, but credit card companies also have a lot of discretion with those kind of things. So not necessarily as much as like buying a car or buying a house, because those are considered loans that you're going to pay them down over time. So the interest rate that you get today is the rate you have. Credit cards are called revolving debt, which means that you're constantly using it up and paying it down and using it up and paying it down. So they have a little more discretion over those interest rate settings. So for you to have a locked 9% rate for a decade or however long is a big deal, because over that same period of time, somebody else who got a card on the exact same day, their rate has been kind of on that roller coaster.
And that was the reason I still remember filling out that form, because like locked 8.9%. I was like, I got to do this.
You filled it in and mailed it in?
I think it was online.
Or you filled it out and mailed it in?
Yeah, I didn't mail it in.
Okay.
I filled it out online. Like I distinctly remember applying for the credit card specifically because of the interest rate. But anyway, real quick question before we go to our first break. Is there any way to insulate yourself as a consumer from movements in the rate, or is it
pay cash?
Pay cash. Okay.
But then you have to worry about your cash, the purchasing power of your cash not being worth what it was the day before.
Right.
Because if you don't have it in a savings account that's actually paying you any significant amount of interest, then you aren't keeping up with inflation.
Right.
So there's always a gotcha somewhere.
This is America. On this episode of Manage Your Damn Money, we're going to cover the world of credit card churning. But as we move to our music break, I want to remind you that you can always catch past episodes of the show on Apple Podcasts, SoundCloud, Stitcher, Google Play, and of course, Spotify. Please leave us a rating and a review on any of those platforms. That helps more people see the show. If you have a topic you want us to cover, an answer or question you want answered by Malcolm, send it to us, info@manageyourdamnmoney.com. And of course, you can always catch us on social media, on Instagram and Twitter. My handle is @MYDM1. Malcolm, how about you?
@MalcolmOnMoney.
And you can always catch us on that good old Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm, where today's conversation at hand is the risky but fascinating world of credit card churning. When deciding on whether and when to open a credit card, most of us know about the basics, determinants of how to pick the best card for us, low interest rate, flexibility on payment dates, avoiding annual fees, and easy servicing of the credit card online. But did you know there's a high stakes, high risk, high reward approach to credit cards, which tries to squeeze the most out of rewards and points? On this episode of Manage Your Damn Money, and just as we enter the holiday shopping season, we are exploring the risky but fascinating world of credit card churning, Malcolm. And the headline that we pulled for this show, how I spent $14,000 taking $195,000 worth of trips around the world. And this is a very old article that I think gets cited a lot. It was a spring 2015 piece on a LearnVest. But the article goes something like this. 8 years ago, my life looked a lot different than it does today. I was living in Bloomington, Indiana, working as an accountant in the finance department for an engine manufacturing company. On a fairly regular basis, I'd jet out to Australia, China, and Mexico to do internal audits at our overseas locations. When I decided to go back to school full time to get my MBA in 2007, I was sad to give up these travel perks and decided to research other ways to see the world on the cheap. That's when I stumbled on a blog about the creative ways you can redeem credit card rewards for amazing travel experiences. Through my research, and who the person is Darius Dibash. Through my research, I learned that racking up credit card points to score free airfare and hotel stays was actually quite easy thanks to a strategy called churning. Churning is when you apply for multiple credit cards in order to capitalize on their lucrative sign-up incentives, which issuers give you in return for meeting certain spending requirements. When done right, you can make back hundreds of thousands in rewards points, but there is a catch. Churning is only for a financially sound strategy if you're able to meet the spending minimums without blowing your budget, and you can pay off your balances in full every month. Otherwise, the interest you'll pay will overshadow any benefits. Malcolm, have you heard of churning credit cards? Is that something you're familiar with ever?
It is, actually.
Okay.
So this is actually how I have traveled this year for work-related stuff.
Interesting.
So I, as you know, have clients up and down the East Coast, and so I've got a gajillion Amtrak points that I'll use to buy Amtrak tickets to go to visit those clients. And actually, the reason that I came across this specific story and was you and I were having the conversation that prompted this episode is because I'm planning our honeymoon.
Okay.
And I'm going to do it with
You
points.
don't want to pay for it?
I'm doing it completely with points.
Well, all right.
Or at least that I should say that's my intention.
Right. That's the goal.
So like flight completely free.
Wow.
Hotel stay depends on what hotel it ends up being. But yeah, my goal is to make sure that it's all done with points.
Interesting. The article went on to say, by the time I graduated from grad school in 2009, Emily and I had accumulated well over 1 million points. My approach was to open 3 or 4 credit cards at a time every 3 months, which sounds insane. No financial advisor would advise you to do that. The theory was that if I spaced out the credit card inquiries, I'd further mitigate any potential hits to my credit. When I first started accumulating travel rewards points, a typical offer was that you get 25,000 points in exchange for charging $500 to $1,000 within 3 months. These days, it's not uncommon to get 50,000 points for spending 3,000 in the same window of time. Some cards gave me specific airline miles. For instance, I eventually accumulated enough to earn American Airlines Gold status, which gives me priority boarding and check-in, better seats, and more miles on paid flights. Redeemed about 150,000 points in miles to take a month-long trip across Europe. In 2010, we took a lavish $32,000 honeymoon in Paris for just $2,000 cash. We also later decided to take a second honeymoon to Bora Bora. The cost, if we didn't have points and miles, $30,000. What we shelled out, $2,000. So I don't think, Malcolm, in my adult life, I really was aware of churning. I think when you sent this to me was the first moment that I really became aware of it consciously. Like maybe I knew it in some dark place of my mind.
Right. You saw it on somebody's blog or Facebook post and was like, oh, whatever, you're lying.
Right. An interesting thing about it, though, because it's talking about points and the accumulation of points. I literally had a conversation with someone about this just like today or yesterday. I think I'm too lazy to actually sign up for, even if we're not even talking about credit card points. Let's talk about hotels.
Grocery stores and...
I don't care. Like, I'm not tracking that. I have to think to go use my CVS bucks. I have to go oh, where's that receipt with the $2 on it? I'm bad at that where I don't want to track or log in through a certain portal to get the points. Like I struggle to do that.
I share your emotion on that.
Okay.
To the extent that it's because it creates work for me to do.
Right.
To get this incentive that may not even be a real incentive.
Right.
So like the rewards bucks from CVS, for example.
Right.
Well, now I've got to physically come back to CVS to spend this $2
and figure out what I want.
And you only give me like 3 days to do it, and whatever. I'll let that one just go by the wayside because that is counter to my rule of I don't go looking for reasons to spend money.
Right.
Because that extra care thing is just to get you in the door to come spend,
Right.
whatever. But with the credit card rewards points, I also caution people similarly, don't just rack up a whole bunch of charges trying to get to the minimum spend because the minimum spend is there and you want the points.
Right.
Because basically you just paid for the points at that point. You bought stuff that you weren't going to buy in the first place. But in this case, we've also got wedding stuff to pay for. So I'll meet the minimum spend just by swiping the card to pay the vendors for the stuff to pay for then the thing that we're going to do.
Right.
And so one hand just washes the other with it. So if it's a scenario like that where you are in the habit of like paying your rent, for example,
with a credit
and you
card,
normally would use your debit card.
Right.
Now you use your credit card to get the points because that's $20,000 or whatever you would spend on an annual basis.
Right.
Well, then that makes perfect sense to me because why not get whatever the extra little kickback is.
Now, the question here really is, it's one thing if you're applying for one credit card or your first credit card or maybe even your second, but, should people be considering cards they wouldn't otherwise need for these kinds of incentives?
If you're disciplined enough.
Okay.
If you're disciplined enough to not use the credit because it's there.
Right.
Like, remember I mentioned the Amtrak card that I have? Well, that card specifically, I opened it because they said, we'll give you however many thousands of points that you can use toward travel if you spend $5,000 or whatever in the first 3 months.
Right.
And so I just made it my mission to exclusively use that card for everything I was going to do for that time period, but not buy things that I wouldn't normally buy.
Right.
Got the points. I don't even know where that card is.
Right.
Like, I just wanted the points.
Right.
So as long as you can be disciplined enough to not go crazy because now you've got 10 credit cards with $5,000, $10,000, $20,000 limits on all of them, then I think you'll be fine.
Okay.
But you got to know what kind of consumer you are.
Right. And one of the things that the article talks about, or what that was mentioned in researching for the show, is the amount of work that it takes to keep up with that kind of strategy.
Right.
Because there is definitely an administrative component to this. What's interesting to me, I'm thinking, it's holiday season. I used to work at not Sunglass Hut. I did work at Sunglass Hut, but also at Banana Republic. And people we would get a bonus as retail, what do you call them, sales associates. And we would get a bonus based on how many credit cards were opened. And it was crazy to me how if you offered like 30% off, people would be like, oh yeah, I'll open a card. I'm like, wait, what? I felt so bad. Like the same spirit that I have on this show, I had then behind that cash register. And so I was like reluctantly, do you want to open a card? Are you sure? And when people did it, I'm like, how are you doing this just so casually? Like,
at least though you were one of those people that will ask once and then if you don't want to, okay. I can't tell you how frustrated I get when people at like Target or something try and force the card on me. And I'm like, I said no the last 46 times I was here. I just said no. English is my first language. I'm certain that I mean what I said.
It sounds like it's yours.
Don't give me the card. And they still are like, well, if you use it, you can. And I'm like, oh my God.
The you can cancel it after you open it thing is the worst.
With that too.
I hate when people
well,
say
you
that.
can get it and then just cancel it once you get it, but use it to get the 5%. And then, no. No, thank you.
So it's interesting stuff. And this was the last point I was going to make about it before we go to our next break. The thing about points is the word points as it pertains to credit cards, and the reason why I don't really track it doesn't mean anything to me. Like, it literally, that's why I have such a hard time with it, because it's such an abstract concept. Like, when you get on a plane and at the end of the flight, they're like, you're going to get 50,000 points if you just apply and hand it back to the lady or the guy, the student, whatever you call them, flight attendant. And
I'm applying.
But I don't know what that 50,000 points does for me.
A round trip flight to somewhere.
I guess, but how many round trips flights do I get?
Even if it's one, a round trip flight to some place that I don't have to pay for is worth it to me to open the card to American Airlines or whatever.
Interesting.
To not have to pay for that flight. Because think about how many vacations you've taken where the biggest burden on your budget was transportation.
Sure.
So if it cost you $2,000 to fly round trip to, I don't know, Jamaica or whatever,
Right.
and then the next time you get ready to go to Jamaica, you get to go for free.
Right.
Okay. I've got 10 minutes to fill out the application. And see, if the Target people were offering me that level of return,
Right.
I would, I'll fill out one every time I come in here. Like, that's a different conversation. Like, if they were like, you can have 50,000 Target points to spend on $2,000 worth of merchandise. Okay. I'm going to come burn this Target down with this card. But, if you're talking about 5% off of this deodorant I just bought, don't burden me with that.
On your Degree or Old Spice.
Right. Like, what am I going to do? Come on.
That's funny. Well, we want to remind people you're listening and watching Manage Your Damn Money with Ben and Malcolm. We're talking about the risky but fascinating world of credit card churning. You can also catch past episodes on the show on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. And, of course, please leave us a review on any of those platforms. That helps more people catch the show. And if you have a question or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. You can always catch us on social media. My handle is @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And of course, that's Twitter and on Instagram. And you can always catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm, where we are covering the risky but fascinating world of credit card churning. Malcolm, question for you. Do you remember your first credit card, the initial credit limit, and what the circumstances were when you opened it?
100%.
Okay.
I'm sure that's hard for you to
Believe.
I remember specifically because I was probably 18 years old in like 2 days when I signed up for it.
Okay.
I was in college. I got a credit card to BP gas station.
Okay.
And my thinking behind
Why
it was
BP gas station?
I am this clairvoyant as an 18-year-old as I am as a 31-year-old man. So what I had learned was the sooner you sign up for credit, the faster you get to build a history, the better your score, and blah, blah, blah. I don't even remember who taught me that.
Right.
So I signed up for a credit card at a gas station thinking, how much damage could I really do at the pump that even as an impulsive 18-year-old shopper, I wouldn't be able to dig myself into that deep of a hole.
So you had this thought at a gas station?
Yeah, well, yeah. So I bought a car, and then I said, well, what do I need now? Gas. So every time I go to the pump, I swipe my card. I had like a $200 or $300 limit on the card, so there was only so much digging I could do. But then that gave me a chance to build up that credit history, and I was off to the races.
That is a hilarious like intersection of thoughts. That's like, oh, I'm at a gas station. I'm gonna get a gas card. That's pretty hilarious.
I still have the card actually to this day. So.
That's funny. My first card, I don't remember signing up for it. But I do remember having that similar thought late in my teens, like, oh, I need to develop a credit history. And my first card, it must have been through my bank, and I think it was a $500 limit, and then it got pushed eventually a year or two later to $1,200, which is where it currently sits. That card like doesn't get used at all, and like sits in my wallet, builds dust.
They probably think you're dead.
No, because the other ones get used.
Okay.
So there's that. But anyway, so that's interesting. So I mentioned before that I had a 9% interest rate on my second card. The APR is typically seen as the most important item to consider when picking a credit card, especially if you can imagine you'll be carrying a balance. What are the other basics people should consider when, picking a card, but then also picking the rewards program that comes with that card?
So I think that all depends on how you intend to use that card. Like we're talking about using the card specifically to get the rewards.
Right.
You don't really have to worry as much about the APR depending on how strong your credit is.
Right.
Excuse me. So when we talk about these different reward hacks, if you will, the caveat should probably be this is for folks who are in a certain tier of credit.
Who are already doing a good job of paying their
You're already
bills.
doing a good job of either not using the cards at all or very much. You don't carry much of a balance, and so nobody's worried about you applying for this 12th card now.
Right.
You also are somebody who has a history of paying it off as soon as you use it.
Right.
And those things show that now we can offer you this new platinum elite double diamond ultra luxury card. That's the caveat to all of this, because it's only a certain group of people who get to constantly apply and apply and apply
Right.
and get approved.
Right.
But also, like, in choosing that, the annual fee is another one. So the ones we're talking about that'll give you like the airline miles and all that kind of stuff, they typically will charge you like $100 annual fee or $150 annual fee. Some of them are up to $500. So you've got to make sure that the fee that you're going to have to pay outweighs the amount of rewards that you stand to get on the back end.
Right.
In some cases, depending on how strong you are, they'll waive that fee.
Right.
But for practical sense, if the fee is $99, you want to make sure that the benefit you stand to gain on the other side is probably twice as much as that $99. Otherwise, why bother?
Right.
Because to your point earlier, it does create more work for you.
Absolutely.
Right. It's not like you're just going through life and these things
and the points rain down
right,
upon you.
it's not like a game of Mario where the points are just accumulating as you walk on your normal course of your day. You've actually got to do some thought and some work for this. Like I've actually seen online when I was reading about this, a guy showed his spreadsheet where he tracks the points, and then he also was talking about how he only applies for certain cards that give you reciprocity on other people's airlines, so you can transfer those points.
To other, right.
That's a little more work than I'm willing to put in.
If you have to have a spreadsheet to keep track of it, I'm already done.
You got couponing people who have spreadsheets to keep track of what's the best day to go to this store with this coupon. And
I'm already done. I've already checked out.
So that's where you lose me. That sounds like more work than I'm willing to do. But when the lady comes through the aisle and says, you just touched down in so-and-so, and we're going to come through with credit card applications, and we'll give you 75,000 points to redeem on your next flight if you sign up now. Okay. Sign me up. I'm sitting right here. I didn't have to do anything.
Well, before we get into the other basics of choosing a credit card, is there a max number of credit cards that one person should have, or is it completely dependent on your credit history? And
it's completely dependent on your credit history, because if you have 15 cards and zero balances on all of them, you've got 15 cards worth of available credit.
Right.
So nobody really cares.
Right.
But if you've got 15 cards and 8 of them maxed out,
yeah.
well, it's unlikely that you'll get that 16th card when you go to apply.
Indeed. Some other basics in choosing a credit card, really quickly. Malcolm mentioned it. APR, or annual percentage rate, is broken up over 12 months and charged against the balance you carry from month to month. This is essentially the amount you're paying to use the card and to carry a balance. Annual fees, some cards have them, some don't. In most cases, people like to avoid these fees unless the benefits of the card are seriously beneficial to your lifestyle, as mentioned, Malcolm said. And then also, this is a big deal. Is it a variable or fixed interest rate? Knowing whether the card is fixed rate that will not change, or a rate that will change with the prime rate set by the federal government. And that could be a big component of what you are charged on balances. Also, the rewards, are there cash rewards, travel rewards, or some other kind of benefit, Malcolm? And it's interesting because one of my second card, it used to be a point system where you can like redeem stuff. Like I bought like a iPhone or phone band for my arm when you run. I used it like 3 or 4 times and decided my pocket was a much better solution than something I'm wrapped around my arm. And then they converted it to cash only, which to me was much simpler. And this is like,
that's also kind of where it gets a little dangerous, the whole chasing points game, because things are subject to change.
Right.
So I could tell you that 50,000 points gets you a flight from here to LA and back.
Right.
And then next year, it only gets you to Austin, Texas.
Right.
And then the next year, it only gets you down to Atlanta. Like,
right.
It's completely at my discretion what those points actually mean.
Right.
So that's
precise. That's precisely why I never really got into it, because in my mind, it's just too abstract to even do anything with. But a big question for everything that we're discussing: how does credit card churning affect your credit? This article we pulled was the high risk, high reward world of credit card churning. This was a spring 2018 piece on the simpledollar.com by Drew Hausman. The benefits of credit card churning. A quick Google search will reveal some truly impressive credit card churning success stories, one of which was the one we just shared. The logic behind racking up credit card rewards is simple. You're going to spend money anyway. Why not get rewarded for spending it? Churning basically takes the strategy to the extreme. Some people even do all of this and still manage to maintain high credit scores at the same time. While opening new lines of credit can ding your credit score temporarily, the high ceiling of all those combined additional credit limits can lower your credit utilization ratio if you're paying down balances promptly. There's also the rush of beating the man. This notion is not insignificant. Some people take a David versus Goliath mindset when it comes to credit card churning.
I think that's a lot of it.
Yeah,
the whole point system. I think people feel like when they get that free quote unquote $10 Chick-fil-A gift card, that they have somehow beat the man.
Can I get the 12 nuggets instead of the 8, please?
Right. I'm having a good day, Chick-fil-A.
Indeed. So some cons of credit card churning. You can get burned by churning too. If you're overzealous, you can dig yourself into quite a hole. Most of these credit cards carry interest rates of at least 16%. We talked about it at some point. The average is about 17%, and they only go up from there. If you charge $3,000 to a card and find yourself in a position where you're unable to pay it off right away, you'll be kicking yourself. Carrying that balance at a 30% APR for 1 year means you'll owe the credit card company an additional $900 in interest, adding insult to injury if you fall behind on your payments. Of course, there's going to be late fees typically associated with that. You also might find that you have to shift into a quote-unquote spending mindset in order to meet all the minimums. It's easy to see how this shift can undermine your whole reason for opening new cards. If you find yourself shopping for things you never would have bought if you weren't trying to meet a sign-up bonus, you're doing it all wrong, Malcolm, what you said. Don't go spending money that you don't need to or weren't going to anyway.
Don't go chasing waterfalls.
Indeed, as TLC always tells us. Another thing to consider is what your near-term financial goals are. If you're looking to buy a house, you want to avoid churning altogether because that just makes you seem like a wild and ridiculous credit risk. And then mortgage lenders are notoriously wary of buyers who have opened and closed too many credit accounts. And you have to stay on top of, as you mentioned, Malcolm, the ever-changing rules of the game. Some banks and card issuers have been cracking down on churning as a tactic, and it isn't great for their bottom line. So the article, I think, went on to say that, like, a bank will say you cannot have applied to this, or that in the last, 24 months, which completely, eliminates, if you're a churner, you can't do it.
So as far as I know, that's news to me if they're now looking at it and saying you can't have applied to one of our competitors in such and such amount of time. I've seen the ones that are like, if you have American Express, for example,
Right.
you can't then apply for the new American Express that has the extra bells and whistles. You just got the light bell,
Light bell and whistle. Right.
I've seen those in the past, but if they now are going as far as to say you can't have applied to our competitor card
Right.
with similar features and whatever else,
Right.
that's
Extreme.
intense.
Yeah.
Like,
I don't know if it's competitor or if it's like one of their own products, but even still, I'm sure there's ways you can track it. But real quick, are there any circumstances under which credit card churning would like make sense for someone? It seems risky to me personally.
I don't see a whole lot of downside to it in the sense that, well,
Assuming you keep up with it.
right. So, like I said, assuming you're a person who's disciplined enough to not just go crazy because now all of a sudden you've got all this credit available to you. I don't see the downside to it because nobody's forcing you to use the card.
Right.
So once you spend the $10,000 that you needed to spend to get the points,
Right.
nothing's stopping you from putting that card in the shredder.
Right.
And then it's a done deal and you walk away from it and move on to the next.
Right.
So I don't really see the downside in that regard, but I do take the point of whoever it was that said part of their strategy is to space out those inquiries so that it doesn't look like you're a person who just constantly is opening cards and can't control themselves.
Right.
Especially if, like you mentioned, you're a person who needs to buy a car, you need to buy a house or whatever, and you're already at that line.
Right.
Then I understand.
It sounds like if you are already settled in your lifestyle and it's going to be what it is for a little while, then you might be able to dibble and dabble. But it is somewhat of a second job. Some other things to keep in mind. It would need to be a serious hobby and passion and something you're genuinely interested in to actually do something like credit card churning on a regular basis.
Saving myself money is a hobby and passion.
Yeah, but would you do this?
Yeah, absolutely.
Oh, all right, well.
I'm not going to be I'm not going to be as extreme as the people that are like trying to figure out which one you can transfer to what place at what value and all that. I don't have that kind of free time.
Okay.
However, taking advantage of, like Whole Foods discounts through Amazon or something, like all for it.
Okay, very good. Also, something else to keep in mind, earning a comfortable living that allows you to pay off balances immediately and without delay is like a really big deal. Also have
Probably should repeat that one.
Well, I'll do that, Malcolm, sir. Earning a comfortable living that allows you to pay off balances immediately and without delay. That's a big thing. If you don't have the income to support this kind of strategy, please do not engage it.
Yeah.
Have greater goals that lend themselves to taking advantage of rewards programs like travel. Like if you're a traveler or you aspire to be a traveler, then maybe you could look at, a couple credit cards and see how you can leverage the points against one another. And then also avoid the extreme practice and use it more practically. Obviously, the articles that we pulled are like extreme situations of people, doing something and taking it to the extreme. Maybe do a little something more light, see how it works, and then go from there. And then also know, as we mentioned, some companies limit the number of cards you can apply for, no matter how great your credit is. And then keep in mind the general principles around credit balances, how they affect your credit, and keeping things all in good balance, Malcolm. So in the world of choosing a credit card, what role should rewards programs at the end of the day play in selecting the card or deciding to, in the spur of the moment, apply for a new card that has some interesting, useful benefits? Like what is a general thing you would say about that?
I don't think it should be your only determinant unless this is like a backup card.
Okay.
Right? Like your primary card that you intend to use for regular, daily, whatever. You want that one to have something attractive like a 0% interest rate, for example.
Sure.
Versus going after the one that's got, the better selection of gift cards that you can redeem the points for or whatever it actually ends up. Then it's like, what really is the point? Or the ones that are like, oh, we'll give you 3 times the points if you shop at this one specific store. Well, there's the gotcha. Right? Now you're going to be in that store burning it down more than you would be because you're thinking about, oh, I've got triple the points, so who cares? So, I don't think my primary card would be based on those elements.
These are like what would you say? Tertiary. Is that a word?
Yeah.
All right. Tertiary cards. Well, anyway, This has been another episode of Manage Your Damn Money with Ben and Malcolm. I want to remind you, you can always catch past episodes of the show on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. And of course, please leave us a review on any of those platforms. That helps more people catch the show. If you have a question that you want us to answer or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. You can always catch us on Instagram and Twitter. My handle's @MYDM1. How about you, Malcolm?
At Malcolm on Money.
And of course, mine is, and of course, you can catch us on Facebook, facebook.com/manageyourdamnmoney. Again, thanks to our partners here at Montgomery Community Media for yet another amazing show. Until next time, be good with your money.
Peace.
Peace.